Today, my guest is Angad Guglani. He is the principal at Cooper Square Acquisitions. He's 24 years old and started investing while he was in college. And to date, he has accumulated over 82 doors using no outside equity. And these properties generate over $25,000 in cash flow each month. In just a minute, we're going to talk with Angad about his story and how he did it. But first, a quick reminder, if you like the show, CREPN Radio, we would love to hear from you. You can like, you can share, you can subscribe, and as always, you can leave a comment. Like I said, we love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel, and that's at Commercial Real Estate Pro Network on YouTube. With that, I want to welcome my guest. Angad, welcome to CREPN Radio.
Thanks so much for having me, Darren. Excited to be here.
Well, I'm really looking forward to speaking with you. Your story is intriguing just by a little bit I gave there. Before we jump into your story, if you could give a little bit of your background, maybe before you got started in real estate.
Sure. Yeah. So I grew up in Pittsburgh, Pennsylvania, suburbs, the North Hills of Pittsburgh, if anyone's familiar. And went to, after graduating high school, went on to college at NYU, the Stern School of Business there for undergrad. And in high school, I had a little business. I always had a little bit of entrepreneurial, like kind of a knack for it. In high school, I used to buy and sell Rolex watches. It was actually a little, it was a good business. It was actually a really good business. But that kind of gave me the idea to get into real estate because I was like, my dad who actually told me this, he's like, okay, so you're good at buying and selling things. Why don't you buy and sell bigger things? And real estate was, aside from companies, right? It's probably the biggest thing you can buy and sell. Maybe you can buy and sell jets and stuff like that too. But for most people, it's a good transaction. If you have the transactional skill set, it's a good place to test your knowledge base.
Got it. So, like I read in the intro, if I understand right, today as we speak, you're 24 years old. Is that still true?
Yeah, maybe by the time it airs, I'll be 25. My birthday is coming up this month in November, but yeah, still 24.
All right. Well, chances are you'll probably be 25 by the time this thing airs. But still,
Hopefully I'll have more
nonetheless,
doors by then too. I mean, I have a good pipeline. I'm trying to end the year with 100. That's really the goal. So hoping that happens.
okay. Well, that's exciting.
Yeah.
So you mentioned you in high school you were doing the Rolexes and having
Yeah.
success, and your dad suggested you look at something bigger. And was that as simple as it was looking to real estate, or was there something else as far as a passion or an interest with real estate?
After that, I was doing watches. I also was very interested in the stock market. That's kind of how I ended up going to Stern. Was I would, was read a lot. I read the Wall Street Journal every day. I used to write for a website called Seeking Alpha, and I would get paid as like a blogger. So I kind of did that a little bit in high school. So I was always very interested in business and trying to figure out ways to make money. And when I got to college at NYU, kind of through happenstance, I met a kid in the dorms. He told me he had his real estate license and was making like $300,000 a year at 19 or 20 doing real estate brokerage in New York City. I was like immediately hooked. I'm like, I got to figure this out. So I got my real estate license, and lo and behold, I was not making 300,000 at least to start. Turns out he was from the Upper East Side. He had some like family friends that would use him to transact, but even that was kind of made up. But anyway, so I had my real estate license and I needed a way to get business, to get clients, right? Because if you don't have clients, you don't have dollars, you don't have transactions, you really are, not really in the business. So I figured out that all of my friends and everyone from NYU that I knew was going to get an apartment off campus. So I ended up creating a website called Off Campus Apartments NYC and a Facebook page to go along with it. And I would market myself. It was initially just me. And as the student rental broker in New York City, Manhattan in particular, tenants actually pay the broker's fee. It ends up being about a month to 2 months, or basically between a month and 1.8 months of rent is the commission. So it's pretty lucrative, right? Because your average rents are $3,000 to $7,000. So you can make a pretty good amount of money just off these rental transactions. So after doing that, after kind of creating a brand behind it, I actually had much more business than I knew what to do with, and I ended up hiring a lot of my friends, and we were every summer we'd run around and rent apartments, and pretty quickly, I think when I was 19, I started making six figures a summer. Um, and
In a
when you're 19,
summer.
yeah, in a summer, yeah, yeah. And when you're 19, you don't have many expenses, right? I was living, yeah, I was living, really cheaply. So I was saving all this money, and yeah, I really always wanted to be on the principal side, right? Buying and selling my own real estate and building a real estate business out of it. And so by the time I graduated, I had a good amount of money saved up. And even before I graduated, I got my first house, I think, for my junior year when I was like 22 or 21, something like that. To get the first house.
So let me ask you, I mean, if you're making 100,000 in a summer
Well,
and you
more than that,
come back,
100,000
I would
summer
say,
actually,
and
but
you
yeah.
come back and you go back to school, I'm guessing there's a question that as you're taking classes from professors and stuff, and you're asking, was there any kind of projection as to what they thought you'd make when you got out of school?
A little less than I was making. Actually, New York, people make a good amount of money, especially most of my peers went into investment banking. So they were all making, right around what I was making a summer outside of school. But I knew from that point on that I really wasn't fit for a job or a career path, at least a traditional career path, because once you get on that entrepreneurial kind of 1099 where you're your own independent business or independent contractor, it's just you prefer it because you like the freedom. I love the freedom. I love being able to have that one-to-one correlation between effort and income. And I still have that, right? When I own my own real estate business, it's kind of that's the one constant we have when you don't have an employer is you really set your own ceiling.
Right. So you mentioned you're on the transaction side, and there's a recognition of, hey, I need to get on the principal side
Sure.
of the deal. Um, what? So I mean, understanding that transactions are fun because there's the excitement. You do the deal, you get paid. You do the deal, you get paid.
Yeah.
Whereas the principal side's not necessarily always as lucrative in the beginning.
Certainly not.
Yeah, what did you see, and what was the appeal there from for you to go to more the principal side?
Well, the appeal was when you're a real estate agent, broker, whatever, what have you. It's this is saying that you're only as good as your last transaction. So you're constantly living in fear. Like, will I get more clients? Will my market seize up? Or will you're just always you don't know where your next paycheck is coming, right? So that was the big appeal of being a landlord and owning your own property is that you have a residual income per se, or a passive income people like to call it. I don't really think it's passive, but yeah, you have a residual income stream that the security of owning real estate was really attractive. And I've always been kind of like a sacrifice now to earn later type of person. Like I always used to save even when I was a kid, so it wasn't hard. I didn't mind the difficulty in the beginning because I knew the long term would be worth it.
Well, compared to I think most when you're in college, I'm just I'm curious if you were to think of your peers, how many of them had a firm grasp on the value of money? I mean, you know, I,
I mean,
I
you
mean,
never know. I mean, listen, I grew up, with an educated family and they put an emphasis on education. I definitely had that as an advantage, right? Some people really had a difficult time, getting into college and whatnot. So I had that advantage, you could say. But then there was also living in New York City, and there's people they're just have no grasp of money. Money flows like water.
right,
Um,
right.
so I just always had a good sense of it, right? I always knew I wanted to have money and make more than, you know, the next year every year. So yeah, I guess I kind of learned that pretty early on, uh,
Well,
that the value
even
of it.
just you hear all the time about kids that are graduating from college and they've got I just talked to somebody the other day, a guy that just gotten out of law school. He had $400,000 in debt, you know, and I'm like, how did? wow. I mean, that's a deep hole. Uh, but it's, I guess I guess where I was going with this was more of a, question of just, um, you clearly had figured out how to make money, and I'm assuming that you were, making more than you needed and able to save quite a bit.
Yeah.
Uh, Whereas, I would question, I guess, whether or not, your peers, uh, and like I said, New York's clearly a very affluent, city in that. But still, I mean, the student loans and all that stuff. How many, kids? Uh, how many kids are put behind the weight of that debt? When they get out, as opposed to having already, launched with, a proven way to make money. So
Yeah, I mean that's definitely a big difficulty that I somewhat kind of got lucky starting this business. That after getting success early on, I didn't really have that burden. But the biggest blessing from starting a business early on when you're in college, right, is number one, everything is marginal, right? You don't have many expenses, so whatever you earn, you can save probably a higher percentage than any other point in your life. Number one. Number two, the part that I looking back on it now my peers are other real estate investors, right? Like I'm kind of out of the whole college scene. And I have an advantage there too because all of my peers now have been syndicating the real estate deals. I own 100% of everything I do. And when you take, well, I mean, I do take partners on it if it's a strategic deal where someone else finds a deal and I'll co-own as a partner in that regard. But if I find the deal and I run the deal, I own 100% of it. I don't take, I never give equity up on those deals. I prefer to use debt, and that I like that because then you get to set your own terms. You get to figure out when you want to buy it, what type of debt you want to put on it. You don't have a hold time. You don't have to report to anyone as to the performance of the asset. You get to kind of run it the way you want. So I think that's the big advantage of starting out with some equity in the game is you get to own more of your deals. And especially the way it usually goes is the deals that you buy when you're just starting out end up being some of your best deals because you start out early, right? And generally real estate markets, if you pick the right market, it goes up. So my best deals were my first couple, the first 10 or 15, because it was 3.5 years ago when things were cheaper.
no, that's awesome. Um, so let's talk a little bit about some of the ways you went about doing it. You mentioned that you've, got no outside investors.
Sure.
Um, were you able to, finance your down payment out of what you'd saved from your, prior, um,
Well, yeah. So
work? Or
I basically saved up some cash. I had a couple $100,000 saved up, and the first couple deals I actually didn't even know. I never thought I started buying in Camden, New Jersey. Still 85% of the portfolio is in Camden, New Jersey. Camden has a historical reputation as being a very dangerous city, but we're working to change that. We're just one of the few people. There's many people, the politicians here, and a lot of big businesses are coming in to really revitalize the city. But anyways, that leads to difficulty in the capital markets, right? When I started about 2.5, 3 years ago, it's very hard to get capital. Now, with a lot of the national players, you can use a national hard money lender to get deals done. But the first deals, I would buy them in cash, fix them up, rent them out, and once you had a package of 5 or 6 or 7, I'd bring it to a community bank and refi out, fully recapitalize, and use that money and keep flowing it. And then about a year and a half, 2 years ago, I started levering up on the purchase using hard money or bridge financing, however you want to call it. And now you can take, let's say you're working with, let's say you're starting out, you work with $100,000 of equity, you can get 90%, 90 LTV now on bridge. So you can really buy $1 million worth of real estate off the get go. And if you fully, you do a BRRRR model and you're able to recap and you could really control a lot of real estate. And if you keep doing good deals, you can keep leveraging your same equity, and hopefully that equity grows, and you can even further leverage it.
yeah, let's talk a little bit about how you find your deals. You mentioned Camden, New Jersey. Um, Other than the fact you mentioned it's considered a more challenging, uh, neighborhood. Can you tell me describe some of the properties you found? I mean, are they distressed? Are they on the MLS? What are the?
Everything we buy is distressed. That's like kind of
Yeah.
the whole part and parcel strategy is like, yes, some of the stuff will come on the MLS, but this is not stuff that we're bidding against homeowners. This is stuff they need quick settlement, bank owned, short sales, estate sales, stuff that's really just needs a quick sale. I buy from a lot of the auction websites. I think some markets are good, other markets they're not, but we've had good luck on those. There's about 8 or 9, I think, real channels that I track on a day-to-day basis as far as where stuff gets sourced from. A lot of it's broker relationships, especially the brokers that do REO stuff, right? They'll get you we like to get the first look. And it also is, once you get momentum, you end up being the buyer in the area, right? So things kind of come your way. Some call it the law of attraction. Who knows? But yeah, you just really I think real estate is you make your money on the buy. So that's why when I started, I called it Cooper Square Acquisitions because really it's an acquisitions business. We like to buy deals opportunistically and we want to make the seller's lives easier, especially the realtor's lives easier. We technically work for them, right? They're our customer. When you bring us a good deal, we're trying to earn your business. So you bring us more good deals.
Got it. So on these, are they heavy lift when you say distressed? Are they tell me kind
Yeah,
of a range
the
of?
housing stock is pretty uniform, right? You're looking at row houses or detached, or they're all relatively the same, so it's pretty easy to estimate. I mean, on average, we're spending about $20,000 a door in rehab, and that could be new flooring, painting. Hopefully, not you're not doing sheetrock. You might have to update the appliance. You're definitely updating the appliances. Might have to update the mechanicals, but on average, some are less. Some are patch and paint. Others are a little more work than that.
Okay. In cash flow, are they? Can you give us an idea of kind of like the acquisition all-in price and what you're
Yeah,
getting
sure.
for rent?
So, yeah, the model would be you buy it if you're doing a job right and you're getting a good deal. You're probably buying around 35 to 40. You're putting in about 20, so you're in between 50 and 60, right? And then you're going to rent the house for about 1,100, 1,200 a month. And from that, you have your taxes, insurance, property management fees, um, and your debt service. So we like to net about $200 to $300 a door in free cash flow every month after the property's fully levered up and performing.
Gotcha. Um, so you're finding these? Do you have your own crew? How are you managing the renovations?
So we have a third-party management company that really takes care of a lot of it, but we're their largest client, so it's kind of like almost like a pseudo partnership type deal, almost like that. And but yeah, they manage it on the ground day to day. But I want to get more involved in that. That's something that's definitely a goal for next year is to really be on top of the renovation process. But like I said, I've been blessed to have a really great property manager.
And what about the renovations? Do they handle the renovations, or do you have
Well,
contractors,
we
or how?
have, I don't know, we have like 7 or 8 different contractors, you could say, or guys that have crews and we bid out each job to a minimum of 3, get 3 bids, and whichever one of our preferred crews gets the best bid gets the job.
Got it. Um, so you mentioned you've got a bunch in the pipe this year that you hope to close out with. Tell me about yeah, your numbers, and are these single family homes? And I want to talk also a little bit about the multifamily properties that you've done.
Definitely. So we had a multifamily building that's kind of on the radar. But as far as actual in contracts, they're packages of single family houses from different REO type sellers or individuals. But we have basically a signed contracts document, right? So every time you sign a contract, you add it to the sheet and you figure out, and that's how you can track what's closing this month and what's not closing this month. But then again, sometimes things fall out, right? You have title issues that come up. Things happen, right? Some of these signed contracts will drop out. Hopefully they don't. But majority of the business is buying single family houses. Why? Because that's where you get the most distressed pricing. Multifamily, we found trades, the spread between the ARV and what it's trading for is much tighter than on a single family house. So
Right.
we like to buy the singles en masse because they perform just like a multifamily property. If you own 100 singles or you're in 100 unit building, yes, it's going to take a lot more work to manage 100 singles, but you can factor that. You can underwrite for that work. But what you can underwrite for is if you bought the multifamilies properties at a higher basis, a much higher basis than those 100 singles cost you, might be better off with the 100 singles, right?
Right. Right. Well, and I think a lot of that, from what I've experienced myself, is if you have if they're close together and you've got uniform materials, or so if the your paint colors are the same, or if you have the same appliances or whatever that might be, to where when you send somebody to a property, they know what they're getting into, and they can,
Exactly.
you know, kind of
Exactly.
keep it simple and stuff there.
I mean, we're doing this, right? But there's much bigger companies that are doing this at scale, right? Blackstone owns, I think, what, 120,000 single family rentals, and they figured out a model. American Homes for Rent is another REIT that has a model. So there is a way to do single family at scale. And the nice thing that I like about single family is also you have two exits, right? Or more than two exits, but you can sell to a homeowner and you can sell to another investor. You can do an installment sale. There's a plethora of options. On a multifamily, your exit is really only to another investor, right? And if you're not in a very desirable investor market, which Camden is desirable, but it's not, New York City, I have better luck selling to homeowners than I do to investors. Let's just put it that way.
Gotcha. Let me ask you kind of the future. What do you expect going forward here? You said you've got some in the pipe for this year, but is this? It sounds like you're a buy and hold uh,
Yeah.
investor. Is that kind of your long
Yeah.
term
The,
plans?
the goal for next year is to buy 200 doors. This year we bought 65. So the goal is to buy 200 to 3x, not Grant Cardone. Grant Cardone says 10x, but we'll 3x hopefully. And then after that, once we have scale in this market, I want to expand to 10 other cities around the country that have similar dynamics where there's a lot of distressed product and a lot of other people are too scared to go into it. And the thesis is basically go where others won't and then try to do it at scale. And once you do it at scale, it becomes a real business.
No,
And
that's
that'll give
good.
you even better of a competitive moat, right? Because then no one can touch you because you're the biggest buyer in the market and you have the best property management operation.
And yeah, you got a head start there too. I mean, that's good. So let me ask you. You mentioned about going where others won't. Um, I know I'm out here on the West Coast in Portland, Oregon, and laws are changing in that. I've recently just read a little bit about the New York market. I don't know if New Jersey's been affected by similar. Are the landlord laws pretty friendly? Are
Um,
taxes better than they are in New York? Or
so the landlord laws in New Jersey are definitely friendlier than they are in New York, especially in New York City. I mean, it's not in Texas. I think Texas has the best in the country from what I hear, or Nevada. I'm not exactly sure, but I mean, they're difficult, but they don't kill our business the way it's happening in Manhattan. And the scary thing in Manhattan, in New York City, is people bought these buildings at like four caps, right? And they're financing them at 3.75 or 350. So you have a 50 bit wide spread, right?
yeah,
And
don't
if you have
don't
a rent
sneeze.
regulation change, you're where's your margin? So even if we have change in our market, we have a nice spread between our capital costs and the yield.
Right.
So I feel comfortable in that, with that margin. And listen, regulators, they have to change the business models to make the lives of their constituents better, whether it's right in the long run or wrong. We have to follow the laws, so there's no changing that.
Oh, sure. No, I guess I would ask as kind of a follow up to that with the just um, tax situation and landlord laws changing. Are you seeing any of a migration out of New York into New Jersey? Uh, is there a? I've read just like various sites talking about which states have the most
The friendliest.
net in or net out
Yeah, yeah.
migration. And I've just seen a couple times where New York and like California have been shown to have the largest net out migration, whereas like Texas has the largest in migration. So I'm just kind of curious if you're seeing any of that.
You're 100% right, right? Like, I mean, New Jersey is, I think, even worse per capita than New York as far as people leaving. Um, so that definitely is not a headwind, you could say. But at the end of the day, my whole investment thesis is if you buy something cheap enough, people need a place to live, and people don't leave cities in mass, right? All the big REITs around the country, they've all picked the same 15 markets to go into, and these are the 15 markets that are net migration positive. And I'm 100% sure that they're very smart for doing that. But at the end of the day, if you have if you have limited competition and you're able to set the pricing and you're able to buy the asset cheap enough, you'll be fine. I hope. I mean, I don't think. Yes, we might not have rent growth. I don't need rent growth. I really don't. I just want a stable tenant base that's happy with the houses that we provide them, and I want to, improve our housing stock so they stay longer and they're even happier. Like I don't necessarily need 3% a year rent growth that a lot of other funds underwrite on their properties because we bought them so cheap.
Sure, and I get the acquisition price, but I think that at some point I would question long term. There's an exit for everybody, whether it's a planned or a forest or you know you're just you're dead, kind of thing. There is an
Oh
exit
my
kind of
god,
thing,
yeah.
But my question, I guess, would be if you were to exit in 5 years, do you see the market? Has it got some momentum? Clearly, you've established yourself as a momentum uh, buyer in the market. Are you seeing that net positive? Are there jobs coming? Is there a
Yeah,
is there,
yeah, yeah, yeah. Camden has been great. I mean, look at the headlines, right? We have big companies moving here. Crime is at record lows. Employment rates are at record highs. Unemployment was the lowest it's ever been in the city. A lot of great things have happened in this market, right? And that's kind of why I came to this market. Is I saw when I came, it was kind of more just like projections, and now it's actually happening. So that's been a good it's been a good run, and I hope it continues. I'm investing in it to continue, and I think it will. But we don't need appreciation. Like we make our money on the buy. So as long as pricing has gone up about 15-20% on the retail, the ARV side, and it's gone up about 40-50% on the distress side, which means our margins are shrinking, which they are. But if the ARVs stay the same, and we're able to exit at the ARVs, less, transaction costs in 5 years because we're trying to sell to homeowners. The eventual end goal is to try to make our tenants homeowners and work with a credit counseling company, a nonprofit maybe, to get the renters mortgages so they can purchase back the houses. It's much cheaper for them to own than it is to rent. And eventually, we don't want to own the swath of single family houses. We want to encourage home ownership because that's what the city wants, and we want to do good by the city. But eventually, in 5-10 years, I hope to work with every single tenant that we have and make them a homeowner because it'll save them money, and it's an exit for us.
got it? Um, what do you see as your biggest hurdle currently?
Biggest hurdle is definitely getting to scale, right? It's very difficult in the beginning. Any sort of business you start, right? You don't have much capital. Capital is scarce. People don't know you. Leverage is scarce because banks don't know you. So really, that's difficult. As far as ongoing difficulties, I would say um, it's kind of unreliable where your product comes from or your distressed real estate comes from, right? We're always kind of a victim of the market. So if the market does very well and there's not much distressed inventory left, then our business model is challenged. It's challenged.
Got it. Hey, I want to shift gears here real quick, if we could.
Sure.
As I mentioned to you before we started recording, by day, I'm an insurance broker, and in insurance, we do some risk management with our clients. And there's three strategies that we typically consider when managing the risk. And the first is, can we avoid the risk? The second option would be, can we minimize the risk? And then the third option is, can we transfer the risk? And that's where an insurance policy is essentially the answer. And I've been asking all of my guests, and I'd like to ask you as well, if you're willing,
Of course.
what you consider to be, the biggest risk. And just to be clear, I'm not necessarily looking for an insurance-related answer, although clearly, if that's what you see the biggest risk to be, then so be it. But with that, I'd like to ask you, Angad Guglani, what is the biggest risk?
So I actually had a few ideas on this, like we talked about, Darren, but you probably gave me a really good story, or you did give me a very good real life story, and that somewhat shaped my thinking. And I would say the biggest risk being very concentrated in one market, and when we expand, we'll be concentrated in the other markets, right? We'll have heavy concentration in a handful of markets. Is something systemic like a major flood or like an ice storm, like that was the example you gave, and something like that where I don't, frankly, I don't read the policies as well as I should. We have a master insurance policy, and I'm sure there's some sort of cataclysmic event that might happen that probably voids the policies, and if that were to happen, that would be very dangerous, number one. Number two, or like you said, if you have a major act of God event, and your policy doesn't pay out, and you have fixed expenses like mortgage and taxes and stuff, and you fall behind on those, that's another big expense, big risk. So yeah, basically anything that comes with concentration, I would say is the biggest risk.
Got it. Always like asking the question and just get people's take on that, because depending on where you are and what you're doing, it's going to be unique. So I appreciate
Of
you doing
course,
that.
of course.
And God, where can the listeners go if they'd like to learn more or connect with you?
Sure. Yeah. If you can reach me by email at ag@cooperacq.com. That's our website, Cooper ACQ, like acquisition. And yeah, happy to talk to anyone, answer any questions, and definitely like to collaborate with other people in the industry.
Got it. Well, Angad, thanks for taking the time. I've enjoyed talking with you, learned a lot,
Had a great time. Thanks, Darren.
and you got it. And look forward to doing it again soon.
Yeah, hope to be back, and I hope everyone has a great day.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.